Morning, we're going to go over overall market reports and give you some updates on the market as a whole. I'm not going to get into details of every single market where we have offices because we have a lot of good information to share with you today. We got great speakers. But with that, let's just take a look at a quick market snapshot in the country. So here's a good table just to show you where we're standing today versus a year ago, same time in November. So as you can see, the median price point is up 6%. The home solds, these are transactions, closed transactions, 28% down compared to the same period. New contracts are down 38%. Sell to list price is 96%. Days on the market staying at 22. Active listings, 28% up. But the new listings getting into the market is 20% down. So this is kind of your market snapshot overall across the board. I think the big numbers to pay attention is the contracts are down almost 40%. And we all know the main reason for that. There's a lot of talk about interest rates, what's happening in the market. Our consumers are reacting to these rates for the right reason. I have this chart to show you. I hear a lot from veteran agents, the brokers that have been in the business, about interest rates, that there were double digits, 17%, 16%. And, just wanted to put that in perspective. That is correct. And you can look at this chart that interest rates were hovering over 18% actually in the early 80s. But what's important to note is the difference and the jump in the rate in just 1 year. If you look at what the rates were same period last year at the end of 2021 and look at where the rates are today, we almost had 4% increase in that short amount of time. This is the biggest year-to-date increase in over 50 years. And that's what most of the buyers in today's market are experiencing. And the other, I guess, important factor to consider is the homes back in the 70s and 80s, the median price point was under $50,000. And today, when you're looking at mortgage size of $250,000 and up, because most homes are selling in the country over $300,000, it's a different market. It's a different game. We are hearing a lot of this in the market because we are seeing a lot of changes in a short amount of time. So this picture, probably a lot of you remember the open houses and people lining up and how quickly that has changed. We had a lot of investors in our market. They started buying a lot of homes by last quarter of 2021. 15% of all the homes were sold to investors. That's nationwide. Now, in the southern markets, that percentage was closer to 20. But I put this picture, just like everything else, the party is over. I think this was more of a sugar hype for COVID. What happened? Haley, I think I lost my screen.
Chelsea, will you stop sharing your screen? Oh, I got it. Sorry about that.
No problem. Do I need to share my screen again?
Yes.
There we go. We were right on the party slide. Yeah, so this was, as I was saying, this was the post-COVID, sugar rush that I think we all knew it was going to come to end. And now we're going to talk about the aftermath and what happened. Zillow offers, they decided to shut down operations. They lost $530 million. I'm sure you've seen some of the headlines about Redfin getting out of the iBuying business. They had huge losses 2 years in a row, and they decided to shut down the complete operations, and they're no longer an iBuyer in the business. We heard about changes in Ribbon. They no longer offer cash offers in the service. Here's a quick slideshow just to show you how much money was lost this year in that iBuying business. Opendoor lost almost $1 billion in 1 quarter. And in Zillow, I think that was a smart move for them to get out of that business last year. And, this year they're going to have profit, where a lot of these high buyers, they're still going to have to show a lot of negative numbers on their P&L. But as you can see, they're selling these homes for about $40,000 loss per transaction. Last one I want to share with you, Opendoor also started a mortgage company, and they decided to shut down the mortgage division about 2 weeks ago. That was announced. They're going to lay off about 550 staff members. So a lot of the models have made sense in a very hot market, demanding market. Now it doesn't, but it doesn't mean that you should panic. The sky is not falling. I want to share with you some numbers. The reality is that when the music stops, there will be chairs. It just won't be enough for everybody. You guys are the best of the best in the industry. RE/MAX agents have always done better, performed better in markets that are less competitive, when there are, I guess, not many disruptors in the business. And you can look back in the history of transaction per count per agent. It's always been better in a tough year for RE/MAX agents as the pros. One more thing I want to share with you. This is just talk about all this venture money in a hot market. A lot of you probably know this brand, Carvana, big disruptor in the car business. They had about $490 million, $500 million of loss last quarter. That totals their loss at $1.5 billion for the year. And now the company is at the verge of bankruptcy. This is a model that we all thought that is going to take over the world. Who's making money? A solid company that's been around. They've got the stores, they've got the market share. CarMax, now they're going to finish the year $1.2 billion profit. So what to expect next in 2023? Less transactions, less investors in the market, less venture capital funded companies. Those are all good news for you. Less disruptive solution in the markets, and less competition. Those are my 5 key points that what you're going to expect in the next 12 to 18 months here. Those are all good news for brokers that are full-time, that are experienced in the business. But realistically, we also have to pay attention to what's happening with the inflation and the Feds. With the inflation still running at 40-year high, Fed is expecting to do a few more rate increases between now and the first quarter of 2023. So that is not going to stop. But if we run into a mild recession, which again, a lot of the experts, they believe that we're already experiencing one, it's important to note that those it can potentially push down the interest rates. We are seeing that the interest rates are slightly down than what it was about 2 weeks ago. If we run into more, the recession field environment, you're going to see a downward pressure on the interest rate as well. At the end of the day, mortgage business, just like any other business, is regulated by supply and demand. And you can see here on this historical chart that every time we experience a recession, it was followed by a pressure on the mortgage rates, interest rates. Here's a forecast of the experts in the banking business. They think that overall, the home prices will go down between 5 to 10% next year. From Goldman Sachs, Wells Fargo, Moody's, and Morgan Stanley. Those are the predictions. Why I don't think that's worrisome to anybody. If you're looking at the number of properties that they were underwater in 2006, 2007, before the crash, we had between 10 to 15% of all the homes underwater. We don't have any of that. That percentage is less than 1% in today's market. So no threat there. Inventory is up, but again, if you compare that to 2019, talking about perspective, guys, we're still about 37% less than what we had in the market as far as homes available to sell. And here's what Dr. Yoon thinks about our business. His forecast for 2023 is that we are going to have about 7% decline in the number of transactions, but the home value will not go down. In fact, he's expecting that it's going to be 1% up overall. And the forecast for 2024 is that we're going to have an increase, another hike in the number of transactions, and followed by 5% increase in the property valuation. That's good news. Here's a chart that I think you should share with anybody that is on the fence thinking about buying a house. The median price point, look what has happened between 1970 through to 2020. By 2050, the average or median price point in the United States is expected to be about $600,000. So buying a house is always the best decision. Last chart to show you is about the mortgage interest rates and what is happening with to mortgage applications. So as you can see, 2020, we had the hike, and that's when we had the most number of applications coming in right after the COVID market started declining by end of 2021 and 2022. But as you can see, between 2022 and 2024, it is going to kind of level out. So we're not expecting any huge drop in applications in the next year or two. But as most experts are telling us, 2024 is going to be another banner year for real estate and mortgage. That was it for today's update, Haley. I'll be happy to answer questions if there are any.
I didn't see any questions in the chat. Just a friendly reminder that we will post Kourosh's slides and the recording on the agent portal after today's meeting. Thank you, Kourosh.